All right, so we'll go ahead and call to order this meeting of the Real Assets Committee meeting. You want to go ahead and take roll real quick, Linda or Bonnie?
Carol.
It's going to be Carol.
Oh, Carol, okay.
All right. Thank you, Mr. Jones. This meeting is being conducted as a virtual meeting, so I'll do a roll call of all the trustees to confirm attendance. Mr. Knox?
I am here.
Mr. Bernstein?
Here.
Ms. Sanchez?
She still stepped away, but she's going to be coming back.
Okay, and Mr. Green is gone, correct? All right. Mr. Green?
Correct. He is gone for the day.
Okay. Chair Jones?
Here, yeah.
Mr. Santos?
Present.
Mr. Keogh?
Present.
Ms. Greenwood?
I'm here.
Mr. Kelly? Staff participating in today's meeting include Principal Investment Officer Jim Rice, guest speaker Mark White, Head of Real Assets at Alborn. Trustees, please use the Zoom chat option to be placed in the queue. At this time, we ask all meeting participants to please mute their mics until you're ready to speak. And now, Chair Jones, we may proceed with the agenda.
Thank you, Carol. Go ahead and approval of the minutes from the June 9th meeting. Do I have a motion to approve?
Knox, I'll move.
All right, do I have a second? Second. I see your lips moving there, Alan. That's the second. All right. Would you go ahead and do the roll for that, Carol?
Yes. Mr. Knox?
Aye.
Mr. Bernstein?
Aye.
Ms. Sanchez?
She's still out, but she'll be back shortly.
Okay, and Chair Jones?
Yes. Okay. All right. So then,
Motion passes unanimously.
do we have any public comment at all within the realm of the Real Assets Committee, Carol?
No, we do not.
Okay. So then we'll proceed on to the substance of the meeting in terms of the attached report, the overview of the mining allocation. Jim, would you like to take it from here, please?
Thank you, Mr. Chair, other committee members, and other trustees. For today's meeting, as you're aware, we've been considering making private investments across the real assets category, including in the natural resources space. Given that we are looking at potential investments in the mining segment, we thought it would be a good opportunity for our consultant, Alborn, to give a presentation on the private investment opportunity space in mining. We're joined today by Mark White, who heads Alborn's Real Assets Group, and he's going to be covering, some of the potential areas we might consider in the segment. So with that, I'd like to turn it over to Mark White.
Thank you very much, Jim. Mr. Chair, committee members, and trustees. What I plan on doing today is giving a high-level overview of the mining space, and I'm going to touch on some particular components, including the portfolio fit, macro fundamentals, ESG, the investment cycle, and comments with respect to our process in searching for opportunities. So with that, I believe there's a shared presentation, and I'd like to refer to slide number 2 on that shared presentation.
Mr. White, do you have the presentation with you? We can go ahead and make you the co-host so you can share your slide.
Okay. Jim, is that the preferred means, or do you have it?
Because Calvin.
I can send it to him.
Carol, did you send it to Calvin?
I will.
Okay.
I'll stand by for 1 second.
Sorry.
Apologies for that. I believe Jim warned that I am the last thing standing in your way of the rest of your day. So I don't want to take up too much time. Jim, with your permission, I'd like to start as you get the presentation ready, because I'm sure board members and committee members have a hard copy of this. Am I correct?
Yes.
Yes, we do.
Okay, Carol. Okay, so if we start to think about mining and where it fits, it's part of the natural resources component of real assets. So it sits alongside in the natural resources as alongside energy, agriculture, and timber. Yet it's at the opposite end of the spectrum, fitting into the risk profile that we see typically in the energy and mining space. And these have been important components of real asset portfolios for an extended period of time as institutions invest in this asset class. It's basically been the premise, to slide number 2, it's basically been the premise on the correlation of commodities with inflation, GDP sensitivity, and other important factors such as correlations and risk reduction to the broader LACERA portfolio. An interesting component of this right now, though, is where mining now sits at a confluence with respect to what we see happening within the energy sector, and indeed within components as we see a major social shift with respect to energy and the way we manage our transportation fleets globally. So mining is a critical input of economic growth. That goes without argument. Its favorable demographic and macro trends are very appealing right now, and it has a number of other attractive real asset investment qualities. But most importantly here is it is a critical component to the green transition. Thus, we consider it as a hedge against decarbonization. So it has all of those other characteristics that we see, such as GDP sensitivity, acts as a leading inflation indicator, high barriers to entry. ESG is a key component of our analysis. So it hits a lot of the check boxes that we believe the LACERA portfolio will be looking for. So the intention of this is to give you this overview, give you a bit of an understanding of what exactly occurs in the mining space and where we see the various investment opportunities. So on to slide number 3. Okay, so basically, the 2 charts provided on this page gives an indication of the correlation between US CPI and the broader BCOM commodity index, which is a combination of energy, natural resources such as agricultural components, but also a very important component of the mining sector. So you'll see that over history, there has been a very tight correlation with respect to CPI. After all, mining and other inputs of the commodity index are an important component to economic development and therefore have a higher correlation. The key thing here is looking at the inflation protection and diversification relative to the other components of your portfolio. The lower bar chart down below just provides a 10-year correlation with respect on an annualized basis with copper and other elements to this. Copper being a key mining mineral, but more importantly, copper is a very important element in the greening of our economy, but due to the electrification of our EV fleets. You'll notice here that energy, in particular oil, has a slightly lower correlation of basically 0.4, where copper has had almost a 0.75. So, and this has been a recent transition, a recent shift in the area. You see all the other elements as well, most notably the S&P 500. Remember, we're looking for assets that are going to be correlation, basically give us a diversification benefit relative to the energy components. Strategic metals such as copper are all trending higher in most recent correlation analysis. And the strategic metals include things such as nickel, rare earths, lithium, that's what everyone on this panel will see in the media, and other elements including iron and even metallurgical coal. And I can get into detail on that later on if there is a question in that direction. So flipping over to slide number 4. What we're trying to accomplish here is to give the board a quick view on what the demand or what the tailwinds have been with respect to the metals in the metal space. And there's two important charts here. So looking at the metal winners, number one. So basically cobalt to lithium demand is forecast to soar as electric vehicle markets expand. And you can see the chart and the anticipated demand increases up to 2030. So currently we're in 2021. We see the cobalt has high demand. You can barely make out all the other strategic metals there because the scale is so small on this. But looking forward to 2030, the utilization of copper, lithium, cobalt, and magnesium in particular. These are all strategic metals. Look at graphite and nickel as well, as these are important components moving forward. The top point here in the chart, the bullet points, just give you an indication of it. So for every EV will require an average of 83 kilograms or 183 pounds of copper per manufactured vehicle. This is relative to the traditional vehicle, a 277% increase in the demand per EV that is going to be used. Another interesting thing is annual copper demand is 28 million tons. 1 megawatt of offshore wind energy requires about 6 tons of copper, relative to the traditional means of the appreciably more than the oil-fired power plants, which is only 1.1 ton per megawatt. So the greener economy requires more utilization of these strategic metals, and this is definitely a strong tailwind. The other thing to note on the other chart down below is what we call the cost production curve, and this is very important in the mining cycle, where we keep in mind the cost of actually mining the mineral relative to the cost of it or the price of it in the spot market. So the ninth decile of the cost curve is the solid line and the current price of copper. So you'll notice that the current price of copper is currently below the cost curve production to the 9th percentile or decile. What this really means is the cost of new copper mining operations is greater than the price. So it's unlikely to see miners investing in more exploration in this place. Therefore, we will continue to see constrained demand profiles or supply profiles for copper in the foreseeable future due to this metrics. Or the alternative is a rapid acceleration of price, bringing it above the 9th decile of cost curve, and we will see more operations heading into the copper space in particular. These curves are calculated, of course, for every single one of these metals, but I thought more appropriate to provide a relevance for this using the copper component. Flipping to
Question?
the next. Yes, go ahead.
Before you move on, Mr. Chair, what are some of the things that drives the demand for graphite, out of curiosity?
Graphite's actually a very important component with respect to the batteries, the renewable batteries. Your elements are, depending on the type of battery being developed, it's either going to be cobalt, graphite, nickel, with actually a little bit of lithium. Yet everyone talks about lithium, but lithium is actually quite a minor component to the actual energy drivers within the battery. So the graphite is a very important component to the battery development.
Interesting. Thank you.
Okay. One of the key issues with respect to mining is having to understand ESG. Now, one of the things about mining is it's always front and center in the public's mind because, unfortunately, as a extractive industry, it does have a physical footprint associated with that. Nobody likes seeing a hole dug in the ground. Yet at the same time, it's a very necessary part of our social development on a go-forward basis. And you've heard me say at the beginning of this presentation that it's a hedge against decarbonization. What that really means is as energy supplies in the form of oil and gas are reduced, we need more metal supplies coming on the other side. So energy's pain is mining's gain, if you will. However, it is still a very high profile area when it comes to ESG. Because it's such a high profile, most ethical miners globally have had to pay close attention for what we refer to as the social license. So mining industry has actually been a leader in the development of ESG policies with respect to an extractive industry due to the public lens that is typically put on the asset class. Government, there's such elements of understanding the mining space as this 360 process. And unfortunately, this 360 process is measured over decades and not simply over the next few quarters. So when you look at a mining operation, you look at the extraction, you look at what's going on with respect to the sourcing of the ore, the movement of it, it has a footprint associated with it. But based on regulations and legislation and quality mining jurisdictions, in 50 years' time or 30 years' time, when the ore body is depleted, it's up to the mining firms to reclaim that land, what we call reclamation, and return it to its natural state as close as possible, keeping in mind that nothing is going to be 100% risk-free, or everything that we do is going to have some form of an impact. So it's an attempt to minimize that impact. So it's basically looking at the E, which is addressed by government. Mining is best practices is started with G, which protects the E and improves S, which of course is the social. The altered landscape is part of the remediation process. It could be creating a water source, such as a lake in the case of an open cut mine, or returning the minescape to timberland or other areas of natural habitat. It will never return back to the natural environment that was there pre-existing because it was an extractive industry, but it will replicate as closely as possible as part of that process. So what we really see, which is important from a public institution perspective, is active engagement in the mining space is a critical element. One of the things that when I'm talking with my clients with respect to the mining and as they look at their investments, I always say it's important to engage by engaging through the operators that are going to mimic and take care of best practices. We also want to push for the ethical sourcing of materials, and we want to be involved with respect to things such as regulatory consultation, and indeed consumer activism is going to drive this. So the 360 approach for institutional engagement is about looking at the metals and mining space subject to classic supply and demand considerations, but keeping in mind that these are influenced by social macro trends. What this really means is, as an investor in mining, mining is going to take place regardless. But as an investor in mining, you now have a seat at the table. You can influence the practices of the mine operators that you're dealing with. You can also influence the practices of other businesses that you're dealing with. The example I like to use often is Tesla. If you're looking at Tesla, ensure that they're ethically sourcing their materials for batteries. If you're investing in an ethical miner, that means Tesla will be buying materials off your ethical miner. It's a win-win for both groups. Regulatory consultation, understanding the state of California, which has a long mining history and a long energy history, has been down this path many times before. And understanding the role of the regulatory environment is critical. Being able to participate in that regulatory environment is even more critical rather than simply standing on the sidelines. Moving to any questions there, because I'm going to move into the part that the test is on later. Okay, on that, I wanted to provide this infographic, which is the best that I've seen from Digital Capitalist Mineral Discovery, dealing with everything on the mining cycle. As I mentioned earlier, the mining cycle is something that takes place over a long period of times. And this here graphic describes the different risk profiles, the different time frames, and what creates that tailwind that we currently see in the mine space. I want to focus on the timeline here. So if you think about what happens with a mining project, I always refer to it as a person walking through a field kicking rocks. The rock is shiny, they pick it up, they say there might be something here. And then we start with the mining process. It could take 4 to 5 years to basically go from the initial discovery of that shiny rock to even starting to think about a pre-discovery component associated with the mining asset. In the cycle of a mine, this is when we start to see a lot of the buzz take place. And you get the speculators coming in. Are there more shiny rocks underneath the ground, or what's the case here? So what will happen typically is they will engage in small exploratory projects, which helps to build the speculation. This happens hundreds of times around the world every single day. And then we get to that one discovery out of the 100 where, hey, guess what? There were really other shiny rocks underneath the ground here. And then we start to look at the reality sits in. So we are already almost 10 years by the time we get to this orphaned period stage. And what the orphaned period stage is really is, we've discovered another shiny rock, but do we really need that shiny rock right now? Let's determine. So the discovery may sit on the sideline for a period of time. We're already up to 10 years. Now this cycle is what is missing. If you recall back on that cost curve right now, if the cost of mining is greater than what I'm able to sell the mineral for, so that's the marginal cost, the next mine opening, then I have no incentive to do this whole exploration process. And if I don't do the exploration process and I even take 3 or 4 years off, and suddenly we start to see a high demand for copper, and then I have to start the exploration process, now I'm 13 years in before I even see a viable mining opportunity. So that's why we refer to this as the orphan period. Then we start to look at the feasibility. We determine that, hey, this mine is going to be below the cost of production for the next marginal operation relative to the price of the metals. Let's determine how economical this mine is going to be. Then we take a couple years to develop, and then we actually get the chance to start up that mine, and then we work to the point of depletion once that resource body is utilized. Every one of these cycles here, and what we refer to as the S curve, is an investment opportunity, but for a different type of investor. Mining stocks, you may have heard of penny stocks before. That's back in the speculation phase. Basically, these things trade for pennies on the exchange. Another thing that's interesting about the mining space is, unlike other private equity opportunities, which typically start in the private market and then move to the public market, mining's the exact opposite. It starts in the public markets and then moves through and continues as a public entity, usually getting absorbed by what we refer to as a major in time. And that's everyone's subjective. But each one of these areas has a various opportunity for various types of investors. We don't consider LACERA to be speculators. The area that we're looking at for LACERA is basically in the development to startup phase associated with the mine. So the last 2 phases of the mining cycle before we start to see the opportunity. If you look at the very top of this infographic, you'll see a risk section that was appropriately put in and how risk starts to tail off. So if you look at exploration risk, you'll see that it tails off by the time discovery is confirmed. Then you have to look at technical risk, then the funding risk, and then the fluctuation of commodity pricing. So these are the various risks. When we look at a mining asset, we want to de-risk that asset. We don't want to take on the exploration risk. We don't want to take on the technical risk. We are part of the funding risk solution to mine operations and mine opportunities when we see it as an institutional investor. Move on to slide number 7. So this is providing basically various structures that we see in the mining space in terms that you will hear from your investment staff. Go ahead.
Mark, if it's okay, just in the interest of board's time, I know there's a request if you could speed up the presentation a little bit.
Okay, sorry. I knew that would happen. Okay, this one here, everybody can read, Mr. Chairman. So these are terms that you will hear from your investment staff at a point in the future. The area on slide number 8, the area that we feel is more appropriate right now for the consideration of LACERA is basically the mine financing stage. And on this slide, you see the positives and the potential issues with it. We believe the positives outweigh the issues, especially with the headwinds that I described earlier on. On to slide number 9. this slide indicates the universe. It is actually a very small universe, but if you look at the stars that are not highlighted in red, these are managers that were included in the search that we are currently conducting for LACERA in the mining space. And as you can see, we are leaning towards the royalty, the stream offtakes, or diversified strategies as we move forward in this area. So there's a case study on page 11 for you to look at to give you an idea of the various investment cycles, or I should say 11 and 12. And then I've also provided on number 13 another graphic to give you an idea of the terminology that we typically see in the mining space. And I want to close out on what drives the cost of production. When you're looking at this nice diagram here, it basically shows you where the ore body is. And typically most mines start with an open cut, which is the perception of the public eye. When we see a mining asset, it is a large hole in the ground, hopefully in an isolated area away from populations, but eventually the increase of that mine turns into an underground operation and will continue to source out on the ore body where it becomes less of a view component associated with the public perception and more of what we consider to be the traditional mining operation. So this is just to give you guys an idea of the terms. I want to leave it there because I want to give lots of time for questions. Jonathan, is that good for you? Jonathan?
I defer to the chair.
I defer to the chair.
No, that's good. I appreciate that very much, Mark. Are there any questions at all from the members of the committee for Mark while we have him here?
I have one quick question. It's probably more for Jonathan, for Mr. Grable, than for Alborn. But Mr. Grable, how does this kind of fit with our continued shift and focus on ESG, you know, with regard to potentially depleting natural resources?
And thank you, Ms. Sanchez. I think that is part of the analysis that that part of the energy transition requires certain minerals and resources. And right now we have exposure through public markets, through our completion portfolio, and this can reallocate our investments to areas more focused on energy transition, which may be more durable and sustainable and not have depleted asset risk associated by virtue of how they're positioned with the economy. But I think that it's incumbent upon us collectively to make the case to the extent this is something that we put forward that does specifically contemplate ESG considerations and heightened ESG considerations.
And I think it also reinforces Mr. Santos' point about having a good PR communications person that as we look to make these kind of transitional investments that our reputation around ESG stays consistent and well understood in that regard. So any other questions at all for either Jonathan or Mark?
I was just going to make a quick point and then a question. I mean, it's interesting to the ESG point. On one hand, you know, you're investing in things like lithium mining and things like that are used in the electric vehicle market and going green for a lot of people. But on the other hand, yeah, there's that perception of mining and the impact on the country where it's located and the people that are working on it. Question on that S curve. Which was very interesting and helpful on page 6 of the presentation. I assume that these change hands a fair amount just in the interim when they're you know, figuring out whether they're going to be feasible. You know, the commodity prices may not be such that it's worth the investment right now. I imagine there's a lot of trade of just the ownership rights or the mining rights of these during that period.
Yes, there is. If you think about the my example about that original geologist, basically what happens is they go to the public markets. The original owners continue to be diluted as new investors come in, and then you have investors, professionals, organizations, and companies that specialize in moving the asset from one phase to the next. For example, the majors that you heard me speak about earlier, they tend to focus on operational aspects, but not necessarily on the funding, the feasibility. They prefer to allow other groups that specialize in that to take care of those risk profiles. And then once the asset's de-risked, they come in and acquire the asset once it's moved into full production.
Thank you.
Any other questions or comments from members of the committee or the board? Mark, thanks so much for your time. Hopefully you didn't feel rushed. There was really a lot of interesting things that you had through there. We look forward to engaging more deeply as opportunities come out from the investment staff around it.
If any member of the committee has any questions, feel free to contact Jim, and Jim will get a hold of me and I will provide the answer.
Okay. All right. Do we have any other staff items at all, John or Jim?
No, we don't have any.
Okay. Good of the order.
Do you want me to do it or you want to do it?
Yeah, why don't you go ahead and do it?
Okay. Mr. Knox,
Nothing, thank you.
Mr. Bernstein,
It's been a good day, and I will see many of you tomorrow morning.
yes. Ms. Sanchez,
No, nothing, thanks.
Chair Jones,
Nothing.
Mr. Santos,
Listen, thank you.
Mr. Keough, Ms. Greenwood.
I've got nothing. Thank you.
Okay, thank you.
Mr.
All
Kelly?
Oh.
Mr. Kelly,
Yeah.
Oh, I thought, because when I took roll call, Mr. Kelly, you weren't there, but now you're here.
I
Mr.
sent you a
Kelly.
message that I was present. Nothing, thank you.
Thank you.
All right. So do I have a motion to adjourn?
So moved.
You guys have a great day.
Bye.
Thank
All right,
you.
take
Bye.
care. Thank you, team.